Two-year Treasury yields are down from their highest level since January as European leaders still disagree on a plan to aid Greece. Joe Balestrino is the fixed income market strategist at Federated Investors. He joins us now from his firm in Pittsburgh with some insight. Joe, welcome to Bloomberg News. Always good to see you.
You too, Mark. Good to be here.
Tell us about this Greece effect, as some are calling it. What's going on?
Yeah, it's trading almost like the Japanese yen. When Greece is in the headlines, you know, the U.S. tends to do pretty well, and vice versa, or I should say the dollar specifically. The Treasury yield curve seems to be looking past a lot of potentially bad news and trading higher in recent days.
Why do you suppose that is?
I think it's a very short-term view of the world, and we would probably take a little bit of exception to it, or maybe stated another way, have been a little surprised. It's all trading on inflation data, and the inflation's been very mild, and with that, especially the long end of the curve. Of course, if you're owning 10 to 30-year bonds, you hate the word inflation. There is no inflation, at least that's what the market's saying, so it's trading up in price quite a bit.
Joe, one of the things that we've been noting here is that when you're looking at Treasury yields right now, in some cases, you're seeing yields higher than they are for corporate debt, and that's something that's relatively unusual. Is that something you're seeing, and what do you think is driving that?
Yeah, we're seeing very, very small instances of that, and that's certainly not in the new issue market. We haven't seen any corporate bond come through pricing yields lower than Treasuries, but yeah, there is some indication that tiny odd lot trades are occurring below Treasury yields. It's the ultimate flight to safety. Yeah, there's been some inklings from Moody's in particular saying the U.S. and the U.K. maybe are on a track toward a downgrade off the supreme AAA rating. So in that world, maybe a corporation is theoretically safer than a sovereign. We wouldn't view it that way.
So in other words, despite the sort of chest beating on the part of Moody's and some of the other ratings agencies, you're not seeing the market maybe take that to heart?
We're certainly not. You may find the occasional, atypical buyer, if you will, or investor for yield, but it's still, everything's pricing off the Treasury curve, and we don't see any reason that changes going forward.
Joe, are we seeing any movement now in risk-free assets?
Any movement in risk-free assets?
Yeah, any bids?
Certainly. I mean, they've done very, very well. Everything has done well. It's almost been too easy over the last couple of months where Treasuries have traded in a trading range, but by and large higher in price out the curve. Anything outside the Treasury space is doing incredibly well, to include mortgages where the purchase program is coming to an end, certainly to include the corporate market, and especially the high yield and emerging debt market. So it's almost the more risk, the better in this environment.
All right, Joe. Well, we're going to break in just for a second because we do have some more headlines concerning Google. Google.cm site is being redirected to google.com.hong Kong. That's according to Google US. Again, the Google CN site being directed, the China site being redirected to google.com.hk. We're going to continue to follow this. As we mentioned, Chris Valerio is at Google headquarters in Mountain View, California, and she's going to give us some more details on this as soon as we get the developments on that. But back with Joe Balestrino at Federated, and we've been talking about the bond market. Joe, right now, you getting a sense that the bond market is taking that short-term horizon?
For sure, Mark. It's trading very short-term in nature. We think inflation, I'll use the word today, is not a problem. But nonetheless, we've put the seeds in the ground over the next, year and a half. We think it becomes a real issue. And with that, you probably have higher interest rates and some currency implications. Today, that's not in the market whatsoever.
Well, it seems, though, as that people, as you say, have this short-term horizon. They're really just looking for yield at any cost at this point. And on that, we're seeing junk bond sales rise to their highest since 2007. Are you guys involved in the high yield market? How attractive do you think that is at this point?
Yeah, we very much are involved, both running specific high-yield product and even more so using it in our multi-sector funds. We are near maximum overweight in that sector, despite the rally that we had last year. And frankly, the first 3 months of this year have been nearly, not nearly as explosive, but very much price higher. We like the market. The corporate bond market can live very well in even a 1 to 2% GDP world, and most forecasts are for much higher than that. Credit quality is great. Default rates are going to plummet. Cost cutting has been paramount over the past couple of years. So the corporate bond market's in very good fundamental shape, and the valuations aren't bad.
Joe, just very quickly here, there have been a few murmurings about the default rate actually going up in high yield, but it sounds like you're not concerned about that.
We're not, and all along we felt that the default forecasts were way too high, and we would even emphasize that word. We think they're going to plummet this year down to, if I had to guess, a 3% kind of a number. And forecasts, in the second half of last year were saying double digits into this year, and we just don't see it. We see a lot of credit quality improvement, and also a lot of companies have simply refinanced their near-term maturities.
All right, Joe, thank you so much for joining us. Joe Balestrino, fixed income market strategist at Federated Investors.